Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
And as we said, we've been wrong many times before trying to forecast or guess risk hitting China. We've underestimated many times the ability of the Chinese government to keep the music playing. As we said, we find it really fresh that the Chinese government criticizes the West for all the money it spends. But when you look at what the Chinese government pumped into their own economy, about half of their GDP last year, and just pure liquidity to keep this game of exports going for them, subsidizing their exports to push out final lower goods prices, probably much more so than even the U.S. So it's an interesting game that's going on here. We just think that there's so much risk here in the world, so much potential risk here in the world. We're just very, very concerned about the Aussie in here. If you look at some of the Elliott wave setup, some people have it going to 110, 120, 140. But again, we just think there's going to be a risk problem in China fairly soon. So we're just very, very nervous on the Australian dollar. So if we do see some type of pullback in risk assets, the Australian dollar will get clobbered very, very hard. We made the case recently that we think the top is in. If we look at this as kind of a wave 5 top, minor wave 5 right here, there are a lot of reasons to suggest the top is in the Aussie, and if it is, it's something that has a lot of air under it that we want to play. One of the concerns that we have is if we see a blow-off in the U.S. stock market again based on liquidity, QE2 provides the liquidity juice investors want, and as we said, maybe some of these tax changes increase some optimism. The Australian dollar is going to go higher, but ultimately we think once China breaks or even slows down from 10% to 7%, the Aussie is going to come off very, very fast. One thing we didn't point out is that the Australian dollar housing market's probably about 40% overvalued, according to Jeremy Grantham and some other estimates that we've seen. Grantham's a pretty smart guy and has made a lot of money on some of these major macro events in the world and has called these things before others in the past. We've had housing markets break everywhere. Some later, some have lagged, and obviously there's a big reason why the Australian housing market should lag. It's because they continue to have growth because of China. So not only would we see the growth fall off in Australia from just a growth problem in China, we would finally, I think, see that housing market turnover and have the same negative consumer wealth effect that we've seen throughout all the rest of the industrialized countries. So that's another kicker in the background that we see as a real risk factor to the Australian dollar. The Reserve Bank of Australia had an interest rate announcement today, and although everybody expected them to stay on hold, what they didn't expect was they seemed to be a little more dovish, I think, than most people expected. We've seen a slowdown in retail sales. We've seen a slowdown in the servicing index. And if we see China, start to slow down because of all the pressures, we'll also see a GDP slowdown and industrial production slowdown in the world. So we continue to watch the commodities complex for some type of clue. So we're kind of on the fence in Australian dollar. We want to catch it if it breaks because it breaks very, very fast and goes very, very far. And I'd like to give you a yay or nay on that, but the reality is we can't. This is our website right here, and if you have any questions on what you've heard today or anything about our services, you can email us there. We offer Currency Professional as our subscription service. It's $99 a month, $995 a year. We have a Currency Investor monthly service that's only $49 a year. We do a big monthly global macro view of the world each month in here. If you're part of this service, you get this for free. We're just cranking up our managed money program. We started with one small account in mid-August, and it's starting to build nicely. And we're registered CTAs with the NFA, CFTC. And we have our free currency currents that you can sign up and get at our site, where John Ross and I kind of make a comment on the global macro environment that's going on in the world that we think can have an impact on currencies, either immediate or longer term. And that's it, Steve. And I'll pass it over to you. And we'll take some questions. Steve, are you there? You want me to just take the questions? Steve. I guess Steve is having some technical difficulties, as they say. I'll go ahead and get started on the questions. First one Jack, is from Scott. This is Jack. Each time I ask you why the U.S. feels it must support the rest of the world economies, but I still do not understand. It's a good question, and one of the reasons they feel they have to do it, I'm not sure it's the best thing for the U.S., but because of the fact that the U.S. dollar is the world reserve currency, and it's held in large proportions, 60-65% range of all reserves are denominated in U.S. dollars. The dollar really is the de facto monetary system for the world. Most all the commodities are still invoiced in dollars. Most all major capital flows across borders, most of them are invoiced in dollars. Because of that, the Fed sees itself, and rightfully so, it basically is a de facto central bank for the world because they control the world reserve currency. So this is why they think they have, because of increased globalization and the wealth of companies in the U.S. driven so much by offshore growth, more and more the Fed believes it needs to fund other countries through this liquidity process in order to keep global growth alive, as opposed to worrying primarily about the U.S. It's a big balancing act for the Fed, and often we see this idea of using the U.S. dollar as really global toilet paper to pump up other nations. We think it's a big mistake and totally agree with you. But there are some rationales for it. Ultimately, we think this idea of trashing the U.S. dollar by creating all this global liquidity is ultimately a bad thing for the U.S. and really a bad thing for the countries that are around the world because of these global imbalances and the way currencies are pressed. It creates liquidity asset bubbles in all these various markets, and although we're probably not there yet, if this game continues, we'll have another major bubble in the emerging markets because of all this liquidity being thrown out there by the Fed. So there's some rationales for it, but there's a lot of rationales against it, and it's because the U.S. basically is the de facto central bank because of the world reserve currency of the dollar. Which country will be the first to leave the euro? Probably Greece. Would probably would be our guess. There's talk of a sabbatical for Greece. If Greece goes on sabbatical, it won't come back. And if Greece goes on sabbatical, guess who else will go on sabbatical? Ireland, Portugal, and maybe even Spain. So if one goes, it will trigger a contagion for the rest of the weaker countries to go, is what we believe. Greece probably number one on the hit parade at the moment.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.